As the USA enters a recession, these 12 states will collapse first. And if you live in one of them, what I'm about to reveal could save your financial life. Right now, while mainstream media argues about if we'll hit recession, we're looking at data that shows we're already there. 22 states are exhibiting recession characteristics as we speak. But here's what nobody else is telling you. 12 of these states aren't just heading for recession, they're heading for complete economic collapse. And we're going to tell you exactly which ones they are, ranked from bad to absolutely catastrophic. But first, let me ask you this. Do you know which state has only 2 days of operating reserves before they go completely broke? Do you know which state has a foreclosure rate of 1 in 172 homes? The highest in America? And do you know which state is facing a budget deficit so massive that every single taxpayer effectively owes $44,500 just to keep the lights on? If you don't know the answers to those questions, you need to watch this entire video because we're about to reveal not just which 12 states are doomed, but also which specific counties and cities offer the biggest opportunities for investors who position themselves correctly. Because here's the thing, we're also going to show you exactly where to find properties selling for 40% below their 2022 peaks, how to capture 300% returns from the commercial real estate crisis, and the exact timeline when you should make your move. What's coming isn't just another downturn. This is a complete reshuffling of the American economy, and you're either going to be on the right side of it or the wrong side of it. There's no middle ground. Moody's Analytics now shows a 49% probability of recession within 12 months. Up from 33% in January. States representing nearly 1/3 of U.S. GDP are already in recession or at high risk. 5 factors are converging to create this perfect storm. First, states are burning through pandemic-era reserves while facing structural budget deficits. Second, housing market corrections are accelerating in overvalued markets with 10 to 15% drops already happening. Third, commercial real estate faces $1 trillion in loan maturities in 2025 alone, requiring refinancing at double the original rates. Fourth, federal budget cuts will devastate states dependent on government spending. Fifth, volatile industries are shedding jobs. We only added 73,000 jobs in July, well below expectations. Now, I mentioned I'd reveal which state has properties selling for 40% below their 2022 peaks. Well, before we get into that specific opportunity, let me show you the 12 states that are in the danger zone, ranked from bad to absolutely catastrophic. Welcome to EconoFin, a team of 5 professionals bringing you smart insights into real estate markets, investments, and strategies, turning knowledge into opportunity. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. The 12 states heading for economic collapse. 12. Connecticut. $44,500 burden per taxpayer. Connecticut ties for worst taxpayer burden at $44,500 per person, with $61.8 billion needed to pay all bills. Despite a $4.1 billion rainy day fund, they have foreclosure rates of 1 in 306 housing units and commercial office vacancy of 27.7% in Fairfield County. Limited opportunities exist in Hartford at $315,000 median prices, but avoid coastal areas entirely. Number 11, Maryland, fresh credit downgrade. Maryland just lost its AAA credit rating from Moody's in May 2025 due to federal spending vulnerability. They face 28,730 federal jobs at risk from budget cuts, the highest state exposure. Baltimore holds 905 REO properties, 5th highest nationwide, creating selective opportunities in Prince George's County foreclosures at 30% plus discounts. Number 10, Oregon, near stagnation forecast. Oregon's official revenue forecast predicts near stagnation with 23.2% GDP dependence on trade and 5% unemployment. Portland ranked dead last among top 100 metros, expecting 7.4% price decreases and 25.6% sales declines. Commercial office vacancy surged to 21.8%. Wait 6 to 12 months for capitulation, then target suburban single-family at 20 to 30% discounts. Number 9, Alaska, oil dependence and population exodus. Alaska earned the number 1 most economically vulnerable state ranking with a CNBC score of 110 out of 445. That's an F grade. 40% of state spending comes from federal funds. They're losing 12,000 plus residents annually, yet Anchorage median prices hit $394,266 despite the exodus. This is a classic value trap. Avoid entirely. Number 8. New Mexico. Federal cuts meet oil volatility. New Mexico faces 43% federal dependence, plus 22,000 plus federal employees exposed to cuts. Albuquerque home sales plummeted 10.4% year over year, with inventory up 24.7%. State agencies predict foreclosures will double in 2024. Avoid this dual exposure to federal cuts and oil price volatility. Number 7. Mississippi. Deep poverty meets economic decline. Mississippi combines 46% federal dependence, 55.2% labor force participation, the second lowest nationally, and median household income of just $35,467. Greenville faces the most severe housing decline forecast in America, 16.6% by August 2025. This state is completely uninvestable given structural economic problems. Number 6. Nevada, the fastest cooling market in America. Nevada holds the nation's highest foreclosure rate at 1 in 2,326 homes with 5.4% unemployment. Las Vegas is literally the fastest cooling market in America, with inventory exploding 44.8% year over year, the largest increase nationally for 12 consecutive months. Home prices declined 2.2% year over year, with continued drops expected. This is a falling knife. Wait 6 to 12 months for inventory to stabilize before entering. 5. Louisiana, America's worst housing market. New Orleans ranks as the worst housing market in the United States, down 7.1% year over year, with forecasts showing minus 5.8% by August 2025. Louisiana has 50% federal dependence, the highest in the nation, with 19% poverty versus 11.8% nationally. Days on market jumped to 74 days. Inventory rose 24.5% year over year. This is a complete value trap. Avoid entirely except ultra-distressed opportunities at 50% plus discounts. Number 4. Illinois. Decades of fiscal mismanagement. Illinois ranks 48th for fiscal health, with every taxpayer owing $38,800 and $172.8 billion in unfunded obligations. They project a $3.2 to $5.1 billion deficit for 2026, despite economic expansion. The teachers' retirement system is only 33 to 35% funded and projected to run dry within 20 years. Illinois ties for the nation's highest foreclosure rate at 0.21%. Chicago holds 1,976 REO properties, the highest nationally. Chicago's commercial office vacancy hits 18.8%, with rents at just $27.30 per square foot. This is a value trap. The state will face catastrophic budget cuts or massive tax increases. Properties in collar counties offer better value than Cook County, but all Illinois real estate carries elevated risk. Number 3. New Jersey. 2 days from financial disaster. New Jersey has the worst fiscal health in America, with every taxpayer owing $44,500 and only 2 days of operating reserves, the worst position of any state. Their teachers' pension fund is only 34.7% funded, the worst major pension plan in America. New Jersey has the nation's second highest foreclosure rate at 1 in 3,059 homes. Atlantic City shows 1 in 200 housing units in foreclosure, second highest nationally. Commercial real estate shows 19.4% office vacancy, with 42 foreclosures monthly. Median home prices jumped 19% year over year to $539,025, a clear bubble signal. Investment thesis? Uninvestable except for foreclosures at 50% plus discounts. Number 2, Florida. 9 bubble markets and your 40% discount opportunity. Now we're getting to one of the states where you can find those massive discounts we promised. Florida has 9 of the top 15 most overvalued markets nationally. Miami earned the number 1 global bubble risk rating from UBS. Tampa shows 42.56% overvaluation, the highest in the nation. Northport is 37 to 40% overvalued. Cape Coral, 37.6% overvalued. Here's where those opportunities are hiding. Cape Coral is already down 10% from peak, with more declines coming. Lakeland shows 1 in 172 housing units in foreclosure, the highest rate in America. Florida's statewide foreclosure rate of 1 in 2,420 homes ranks second nationally. Rental vacancy hit 10%, 47% above the national average. The insurance crisis is making everything worse. Hurricane Ian caused $112.9 billion in damage. Premiums are skyrocketing, and HOA fees jumped 15% plus year over year. But Florida has strong long-term demographics that will support recovery. Target foreclosure acquisitions in Cape Coral, Northport, Lakeland, and Punta Gorda at 30 to 40% discounts to 2022 peaks. For commercial investors, focus on distressed multifamily from over-leveraged developers with 11% plus vacancy. Number 1. California. The Golden State's House of Cards. California faces the largest budget deficit in state history, $55 to $58 billion, while pulling $12 billion from reserves. The median home price of $825,000 requires an annual income of $237,000, but median income is only $96,500. Monthly payments average $5,900, consuming 36% of income. They have 5.5% unemployment, $20 billion in unemployment debt, and 239,575 residents fled to other states in 2024, the largest domestic migration loss. The state carries $244.9 billion in unfunded pension liabilities with extreme revenue volatility. But here's where the commercial opportunity I mentioned comes in. California leads the nation with 187 commercial foreclosures monthly, 30% of the national total. San Francisco office vacancy hit 28.8%, with rents plummeting from $88 to $64 per square foot. The LA Gas Company tower, appraised at $632 million in 2020, now faces foreclosure at $200 million. Target the Central Valley and Inland Empire. Bakersfield shows 8.7% unemployment. Merced County hits 9.1% unemployment, and Stockton requires 66% of wages just for housing. Riverside San Bernardino shows foreclosure rates of 1 in 867 homes. Remember I promised to tell you about the one type of property becoming completely worthless? It's traditional office buildings in secondary and tertiary markets. Office foreclosures surged 117% year over year to 625 monthly, the highest since March 2015. Now let me reveal those 300% returns. $1 trillion in CRE debt matures in 2025 alone, with most loans facing refinancing at double the original rates while values declined 20 to 40%. Office conversions offer the best risk-adjusted returns. New York City leads with 4.1 million square feet of conversions, creating 17,000 plus new homes. LA amended its adaptive reuse ordinance in December 2024. Target distressed office buildings under $150 per square foot in New York City, LA, Boston, and San Francisco. Properties like the LA Gas Company tower create 3 to 5 times return potential over 5 to 7 years. Multifamily shows extreme bifurcation. Record supply of 636,000 units created severe oversupply in Class A luxury, 11.1% vacancy, while mid-market maintains 7.1% vacancy. Target distressed Class A acquisitions in Austin, Raleigh, Nashville, and Florida at 20 to 30% discounts from over-leveraged developers. Say that 10 times fast. Retail defies predictions with vacancy at a 20-year low of 5.3%. Industrial normalizes at 6.8% vacancy. Distressed debt offers double-digit returns with $585 billion in dry powder and banks selling problem loans at discounts. Let me be crystal clear about where you should and shouldn't put your money. There are 8 markets you need to avoid entirely: Mississippi, Louisiana, Alaska, New Mexico, Illinois, outside the collar counties, New Jersey except for foreclosure plays, Connecticut's coastal areas, and Nevada until we see inventory stabilization. These markets face permanent structural decline with no positive catalysts on the horizon. Now, for the opportunistic plays where smart money is moving, focus on California's Central Valley and Inland Empire foreclosures, where you can pick up properties at 30 to 40% discounts. Florida's Gulf Coast markets are offering the same discount levels right now. Las Vegas will become attractive once inventory stabilizes in about 6 months. Portland needs another 10 to 15% correction before it hits bottom. And if you're looking for immediate opportunities, Baltimore and Prince George's County foreclosures are available at 30% plus discounts today. On the commercial side, the biggest opportunities are in New York City and LA office conversions. Target anything under $150 per square foot with the right floor plates. California's distressed office debt is trending at 40 to 60% discounts to par value. Florida's Class A multifamily properties are available 20 to 30% below replacement cost from over-leveraged developers. And don't sleep on grocery-anchored retail in supply-constrained markets. That sector is actually strengthening. Here's your timeline for maximum success. The commercial maturity wall peaks in 2025 to 2026, creating maximum distress across all these markets. You need to position your capital now, deploy it aggressively during 2025 and 26, then harvest your returns from 2027 to 2030 as markets recover. Keep in mind that foreclosure timelines vary dramatically. Nevada's non-judicial process moves in 4 to 6 months, while judicial states like Florida and Illinois can take 12 to 24 months. For risk management, never go above 60 to 70% leverage. Maintain those 30 to 40% equity positions. Build 12 to 18 months of cash reserves for debt service because you don't want to be forced to sell during the distress period. Avoid floating rate debt entirely in this environment. And most importantly, only invest in markets with positive long-term demographics, population growth, job creation, and economic diversification will drive your recovery returns. The 12 most vulnerable states face economic collapse risk, but smart investors will build generational wealth from this crisis. California, Illinois, and New Jersey face the most severe systemic risk. Florida, Nevada, and Oregon offer the best risk-adjusted opportunities given strong fundamentals and current corrections. Remember those 4 secrets? The 40% below peak opportunities are in Florida's Gulf Coast markets. The 300% commercial returns are in New York City and LA office conversions. The property type becoming worthless is suburban office buildings. And the exact timing is deploying capital in 2025 to 2026 when the maturity wall peaks. Not all vulnerable markets are created equal. Some face permanent decline. These are value traps. Others face cyclical corrections in sound markets. These create opportunities. Success requires distinguishing between the two and having patience to wait for true capitulation. The investors who master this distinction will build substantial wealth from America's economic crisis. You now have the roadmap. Will you have the discipline to follow it? If you found this video interesting, please subscribe, share, and watch this one as well.